Great. Yeah, good evening, everyone. Thanks for joining us. My name's Daniel Mansubi. I'm just one of the directors here at Lanescape. Thank you for joining again. Tonight is going to be the third installment of the speaker series. As most of you probably know, the session is going to be focused around financing, so unlocking financing, better understanding lending options for laneway and garden suites. For anyone who's new to us, Lanescape is a Toronto-based design build firm. So we specialize, of course, in laneway and garden suites. We guide clients through the full process from feasibility to approvals and construction, and we've been doing so since 2018. So, as per every session, I'm joined by my co-host, Craig Race. Craig is the founder of Lanescape. He also played a key role in shaping the bylaws that made laneway housing possible in the city. And we're also appreciative and excited to welcome Chris Mulder. Chris is an industry expert as well with regards to backyard housing and is a principal mortgage broker. So he'll be able to, of course, speak to the financing portion quite in depth. As we go along the session, please feel free to drop any questions in the chat. You'll see the chat box at the bottom of your screen there on the Zoom panel. We'll answer them likely along the way, and then towards the end, we'll also dedicate some time to doing so. And of course, if you're curious about your own property, we do offer free assessments. For those of you who had requested one prior to the session, I believe we've essentially gotten nearly all of them out. So check your inbox if you're curious to see what you can develop on your lots. Chris, I'll hand it over to you and Craig, and feel free to get things started.
Well, if you don't mind, Chris, before we get into it,
Sure.
we always like to know who's in the audience so that we can customize our information to the people who are in attendance. So if everyone wants to let us know why you're tuning in tonight, we'll try to make sure you get the relevant information. We usually get a lot of homeowners, but if there are real estate agents or architects or builders in the audience or anyone else, we'll do our best to help you out. And I'll further introduce Chris just by really emphasizing what a unique position he holds in the market. It's pretty rare to have lenders or brokers, I should say, focused on small scale infill housing typologies. And Chris is one of them. Like, not only is he a broker for other lenders, but he also has a family fund where he funds laneway house and garden suite projects. So he's one of the more knowledgeable people in the industry that focus on this typology. And Chris, I know you've got a lot to share with us, so thanks very much for joining. It's rare to find someone of your stock, and we're glad that you can help us spread the good word tonight.
Well, that's a wonderful intro, Craig. Good evening, everyone. As introduced, I am Chris Mulder. I'm the principal broker and owner of Tridac Mortgage. I'm here to talk to you tonight about financing for ADU projects. Lucky me, it is probably one of the most boring topics when it comes to the ADU topics that are going to be covered on this speaker series. But it's the most important, one of the most important. No money, no construction, right? So I'm happy to be here. But before we get into the presentation, I want to say a quick word of thanks to Craig and Daniel for inviting me. As Daniel already said, Lanescapes and Craig and the team have been really at the forefront of pushing forward the viability of ADUs. Their work has been instrumental in shaping policy, design, and through this speakers series, they're continuing to advocate and educate around these unique typology of houses. And for me, it's an absolute pleasure to be here and have the opportunity to speak to you about construction financing for ADUs. So the game plan is to speak for about 20 minutes. I'll do a quick introduction to myself. I'll pull Craig in to have a quick talk about ADUs as well, where we are in the timeline and trajectory of ADUs. I'll talk about some of the tools that we have to finance them, and then wrap up with 2 case studies before throwing it back to Craig and the team. So a little bit about me. I mean, I'm here as a mortgage broker, right? And why a mortgage broker and not a banker? And the reason is because when you deal with a bank, they're there to do one thing and one thing only, which is sell you that bank's product. And they're not very interested or well-versed in taking a step outside of the little sandbox that they play in. So it's very difficult to get a banker to be interested in doing construction financing, let alone ADU financing. And so as mortgage brokers, we work with banks, we work with credit unions, we work with private lenders, and everything in between. So we're in a good position to use the different tools that are available in the marketplace to address the unique needs of each individual borrower. So that's why I'm here as a mortgage broker. Now, what is it that I do as a mortgage broker? In its simplest form, I connect people who need money with people who have money. And for me, this is a family business. I'm second generation. You can see there's a picture of my dad and I. And one of the things that my dad did back in the early 90s was set up a unique private mortgage fund. It's something called a mortgage investment corporation. And over the decades, learning from my dad, we went out, we did visited construction sites, we funded all kinds of multifamily projects. He took me along, and here I am almost 2 decades later as the president of the fund with all that experience and the benefit of that experience. Outside of the mortgage world, you'll find me at Cherry Beach. I love sailing. I'm into high performance catamaran sailing. I wing foil. If anyone here knows what wing foiling is, drop me a line. We'll see you at Cherry Beach. I live with my wife in Leslieville, and as a prerequisite for anyone who lives in Leslieville, of course, we have a dog. That's my dog, Moscow. You may hear him barking in the background, unfortunately, so sorry about that. Okay, so let's talk about what an ADU is. When we're, and many of you on this call may already have a good idea. You'll hear this acronym ADU, additional dwelling unit, is what we're talking about. And there are two main typologies that we generally refer to, which are laneway suites, garden suites. Craig and the team can talk more about this, but laneway suites are secondary dwellings constructed behind traditional street-facing homes on lots abutting a public laneway, and supportive zoning bylaws were introduced in 2018. Garden suites are detached secondary dwellings located in the rear yard of a principal residence, right? So no laneway. And supportive zoning bylaws were introduced much more recently in 2022. I'm going to pull up Craig, Daniel, anything to add to that that you want to interject or add any additional color? These are your beautiful renderings here, by the way.
Yeah, I appreciate the reference or the credit, I should say. No, I mean that's a good explanation, and I think the fact that they're accessory structures makes them particularly useful to families, but also particularly challenging to finance, right?
Yes, absolutely. Yeah, and so as we go into this presentation further, we'll dive into that a little bit more. But one of the things, Craig, and you can add a little bit more to this as well, is we have special thanks to give to Jeff Allen. I've noticed some of your other guests have used this data as well. I've given this presentation before and used it, and it keeps on getting updated. So Jeff Allen, through the University of Toronto Urban Studies, and I've got the source of this information there. As of January 2026, there were 621 ADUs completed. And the reason I think everyone likes to talk about this is because it demonstrates two things. It demonstrates how early we are in the ADU potential. Only 621 completed projects have been done, but you can see how the growth has been really growing exponentially. Of course, in 2018 was when the bylaws were introduced. And then from there, we had a trickle, and then a little bit more consistent. 2025 was a great year. Craig, do you have a pulse on what 2026 is going to look like?
I think we're starting to plateau a little bit. In Vancouver, they approve about 500 per year. So I think we're going to start to see some tapering off, and I would imagine we'll settle in around that number, maybe a little below it. But one perspective I like to provide on these numbers is like we are literally producing the equivalents of high-rise buildings worth of rental housing, just invisibly embedded into our neighborhoods every single year. And all it took was a simple zoning bylaw change. So when you consider the impact that just everyday homeowners are having on a rental housing market, it's pretty spectacular.
Yeah, yeah, it's a great point. And further to that study here, you can see that. So one thing is to have completed units. This graph is showing how many in progress permits there are. So close to 1,000. And perhaps to add a little bit of context to this, these are permits that have been issued. It doesn't necessarily mean that they'll come to completion. There might be a number of factors and reasons why a permit is issued and the construction isn't completed, but it gives you an idea of the pipeline. Anything else, Craig, on that one that you want to add about the permits in progress?
Yeah, that's right. Usually by the time someone's got a permit, there's a very high hit rate of the project being completed. So the drop-off rate's pretty low. These are very real numbers.
Right. So in the pipeline, potentially close to 1,000 ADUs over the next 12 to 18 months, perhaps. Now, looking at the potential, so you may evaluate that for anyone that's watching this. That number may be impressive. It may be shockingly low. It depends on your perspective of it. But I think the potential here is tremendous. We're only scratching the surface. This data is thanks to another advocacy group, adusearch.ca. And there are approximately, well, it's a pretty specific number that they've come up with, 474,022 total properties in Toronto, of which 318,000 are suitable or potentially suitable for not AUDs, but ADUs. Sorry about that typo. Craig, maybe I'll ask you here, what does it mean to say suitable or potentially suitable from
Yeah,
a bylaw perspective?
We'll get into the bylaws in a little bit. Usually the number one factor that can sterilize a property is emergency access. And that is like not having enough space between your main houses, or you're too far from the end of a laneway for fire, police, and ambulance to access the suite. Um, the other alternative would be just really small backyards. Like there are some properties that just have teeny tiny backyards that are not
Mm-hmm.
suitable for a second home.
Mm-hmm.
But these numbers align with what our assessments show us, and the vast majority are perfectly suitable.
Yeah. And this is a map also from that same study. The yellow X's are the approximately 1,000 permits that have been issued in progress permits. The green dots are the completed units. And you can see the concentration, right? As you probably would expect in the neighborhoods east and west of the downtown core. You can see them popping up there.
I love the spread on these. The trend that we tend to find is that the really big clusters in the more core east and west neighborhoods downtown are really where we see a lot of rental units. And
Mm-hmm.
then all the kind of the starry sky around the periphery is where we tend to see a lot of multi-generational opportunities. That's not a hard and fast rule, but
Yeah.
the more suburban sites are really good for, kids moving out of the house but not too far away from the house, or parents moving out of the house but not too far away. So
Right.
they really have different opportunities depending on the site.
Yeah, yeah. Well, it's nice to see them spreading beyond the downtown core because traditionally we thought of them as, a downtown solution. But this is going all the way up to the border. I guess the border would be Steeles Avenue up into North York, right? So we're going all the way north. So that's a quick overview and perspective on ADUs, just to frame this conversation. And but we're here today to talk about how we actually finance them. So I'm going to give you a brief crash course on construction financing and the tools that are available to homeowners in order to finance the construction of them. So let me give you a quick rundown of those different tools, starting with lines of credit. And this is the low-hanging fruit and the most obvious and flexible choice. So lines of credit, who issues them? They come from the bank. Interest rate is typically prime plus a half. And the benefit of a line of credit is that it gives complete flexibility for a homeowner to draw on funds on their own terms. They don't need to ask for permission or meet certain stages in the construction. They can, with confidence, write a check for whatever amounts required to finance the construction. Then typically lines of credit can be converted into a mortgage later, but it gives complete flexibility. The problem is with a line of credit that you have to have lots of equity, and qualification can be challenging. Okay, so not everyone will fit into the bucket of being able to build an ADU through a line of credit. An alternative to a line of credit would be a construction mortgage. Now, construction mortgages at the bank can be a little bit of a dirty word. You have to speak to the right specialist who understands it. Some banks have construction programs, some don't. And the concern, why banks don't love construction, and you have to remember that when we're talking about construction, we're generally talking about, or the understanding from the bank is that it's construction on the main home. Okay, I know our conversation today is about ADUs, but the policies of the bank are generally designed around the main dwelling unit construction. And when construction occurs, it usually involves, in order to get to the finished product, it involves a brief period where there's complete chaos. There might not be a roof, there might not be walls. And so for that brief period, 6 to 12 months while construction occurs, the value isn't there of that property. It's not marketable. And that is a major concern for a lender, because a lender and a bank always assumes that you are not going to pay your mortgage. That's always the baseline assumption when they're underwriting. And so they say, well, if you're ripping off the roof of your home and you don't pay the mortgage, we're not in the business of completing construction projects. And that's why there's a real kind of fear or a lack of product offering from banks for construction. However, some banks are willing to do it. Now, it is the lowest cost option for borrowers. Construction mortgages need to be done, especially from the bank, need to be done in first position. So if you have an existing mortgage and you go for construction financing, you'd have to break your existing mortgage and do a new first mortgage. But because of the risks that the bank takes on, borrower qualification is quite strict, and there's strict underwriting as well in terms of how funds are advanced and under what circumstances funds are advanced. So construction financing sometimes works for ADUs at the bank, and at other times it doesn't. I'll get more into that in future slides. So if it doesn't work at the bank, then the next kind of tier of financing available would be private construction financing. And private construction financing is dealing with private lenders, usually specialized in construction, with a better understanding of some of the unique challenges and the flexibility that's required around construction financing. Yes, the interest rate is higher, but you're paying for more flexibility in terms of qualification, in terms of how funds are advanced, how funds are paid. And typically, when we come up with a second mortgage for construction financing, we like to keep your existing first mortgage in place and arrange a second mortgage to complete the construction. And then at the end of the project, once everything is done and the dust is settled, we consolidate everything together. More on that on future slides. I'm going to mention a very unique product that was introduced January of last year. It's relatively new. It's called the CMHC Secondary Suite Refinance Program. So CMHC is Canada Housing and Mortgage Corporation. And they came out with this solution to facilitate the creation of more rental units in urban areas. And this program is very, very unique because it will allow the typical threshold for the first three options in terms of how much financing is available is capped at 80% of the property's value, the as complete value. With the CMHC program, the loan to value is capped at 90% of the finished value of the property, up to a $2 million value. There are some caveats or terms around it. It must be an owner-occupied property, so at least one of the units must be owner-occupied. So you could live in the main house and have an ADU installed. It could be a basement apartment or duplex, triplex, up to 4 units. Beyond 4 units, you now get into construction financing, which is a totally different topic. But similar to, if you're familiar with purchasing with, if you're buying a house with less than 20% down payment, there's that mortgage default insurance that gets charged. And with this specific product, if you did borrow 90%, there would be an insurance premium that gets charged on it. Okay. I was going to open up for questions here. Craig, Daniel, how am I doing? Any questions in the chat? I don't see the chat, so I don't know if there's anything that you want me to
add. Somebody has just asked a question. So Sandra is just wondering if a property includes main dwelling units plus an ADU regarding the up to $2 million.
Yes. Yeah, and I'll add more color to that, Sandra, as part of the case study. That's an important question, and we'll probably take up the bulk of the rest of the presentation. So we'll address that. That's a great question. Anything else there, Daniel?
No, but honestly, I'm learning a lot so far. So yeah, keep going.
Cool. And I'm including this little piece of information here because it sometimes creates confusion. In the January 2025 federal budget, so that one was presented by our old finance minister, Chrystia Freeland. They presented a Canada Secondary Suite loan program with lots of fanfare. So this was going to be a loan of up to $80,000 at 2%, amortized over 15 years for anyone that was going to create additional housing. So it could have been for a secondary suite, basement, any of these things, including an ADU. But for whatever reason, it got axed. It never came to fruition. Surprise, surprise. I think it was part of the government's policy to show, it was all politics, to show that there was an attempt to improve housing and address the housing shortage that's so well documented, and becomes a political issue. So unfortunately, this Canada Secondary Suite loan program is no more, but you'll still see some residual information online about it, which creates confusion. Okay, so those are the tools that we have in our tool belt, so to speak. The lenders are banks, credit unions, specialty construction lenders, private lenders. And I'm going to focus the discussion now specifically on construction financing, right? So if you're able to get a line of credit, that's a totally different story. But if you need to rely on construction financing, there's some unique characteristics of construction financing that you should understand. The first one is that funds are released in stages. So as opposed to any other refinance that you might be familiar with, where you get all the money lump sum at closing, when you arrange construction financing, you typically don't get any money at all upfront. And instead, funds are released in draws. Number two is there's higher lender scrutiny due to the project risks. We need to provide performas for the expenses, permits, of course. And so there's more underwriting. And as I mentioned, it's not every lender's cup of tea, right? So you really need a specialized lender that understands the unique circumstances around construction financing. So here's an example of the construction draw schedule. And what happens is each stage, each milestone in the construction is allocated a certain percentage. For example, if we look at mortgage draw number 1, excavation, footings, and foundation is allocated 12%. Damp proofing, weeping tile, and backfill to complete your foundation, 2%. Framing, sheathing, and roofing, 17%. So you would complete that work with your contractor or builder, and then an inspection would be done, and 31% of the construction would be deemed to be complete, and that would be advanced to you to pay your contractor. And the schedule continues at different stages. Okay, so this is just an example. There is flexibility in terms of how funds are advanced, but you can see that, especially with that first draw, you do need money yourself to get the construction started before a lender will advance money to you. So you need a float, so to speak, and contingencies of your own cash to make it work. It's very hard to make this work without your own money in it as well.
Chris, I assume that's normally 20 to 30% of the project cost, right? That you have to have funds in hand.
Yes, yes. The more contingency, the better. Yeah, and in general, for underwriting purposes, a lender would ask to see at least 10% of the budget, of the total budget, including the soft costs. And but I think, and anecdotally, you may be able to add more to this from your own experience. 20 to 30% is probably safer. Agreed?
I think that's wise. Also, just for the benefit of our listeners, hard costs are often what contractors will quote when they're talking to you about the build cost, and that's really just labor and materials. So it doesn't include things like taxes, your permit fees, the cost for your consultants. Often it will exclude things like construction management fees. So there is a difference between like a hard cost and a soft cost and a full project budget number. So always be mindful of that.
Yeah, yeah, very important. And I think, yeah, I mean, that's a topic and a presentation in and of itself, all the financing around that, the line items. So now just once you get the advance, or how an advance would actually work, just to be aware of, devil's in the details. So first thing to know is that of that 31% that gets advanced, going back to that previous slide. So let's say you complete all this work, 31% gets advanced. 10% of that amount is required to be held back because we have a Construction Liens Act in Canada. And under that act, any financing is required to, or funds are required to be held back for an instance where a contractor isn't paid according to their contract. So there's protections for builders and contractors. So 10% gets held back until the project is complete, and then those funds get released to you. How we deal with interest payments really depends on the lender. But typically, if we're doing a private second mortgage construction, we'll either do prepaid interest or an interest holdback. And what that means effectively is that it won't be a drag on your cash flow. Instead, the interest payments are deducted from the financing that's provided. Okay. And then there's some transactional expenses as well. Every time you do a draw, either the lender themselves will go out and do an inspection, or an appraiser will go out. So that's a couple $100 for an inspection. The money flows from the lender to a lawyer and then gets released to you. So there are legal fees and disbursement costs. There might be a lender administration fee. And so there are transactional costs associated with it as well. So now I'm going to talk about some of the qualifying factors. And one of the important things when we think about construction financing is this idea of the as complete value. So there are two values that matter. There's the as is value, so establishing what your home is worth today as it stands. And then the as complete value, which is a projection of if all the work that is being shown or projected to be completed is completed and an ADU has been built, what will that do to the value? So keep that in mind. We're going to circle back more and talk about the as complete value. The other factor is the exit strategy. So when I speak to my clients about arranging construction financing, it's one thing to get the money for the construction. Another thing, at the end of the project, now you have to consolidate everything together and live with that financing. We want to make sure fundamentally that you qualify for the final takeout mortgage amount. And then number three is this idea of skin in the game, having contingencies, as Craig mentioned. You want lenders looking for 10%. I think a 20% contingency would be a lot safer. Daniel, any questions there in the chat? I'm going to go through the two case studies quickly and then wrap this up.
Yeah, we do have one from Ronald, which is referring to a couple slides back, but he's wondering if friendly material liens scare away construction financing.
Friendly material liens. I don't understand the time. Sorry, I might be dense about this. My P-sider's brain may not comprehend it, but I'm kind of curious what friendly liens are. A friendly material? What did he call it?
Yeah, I've never heard of a friendly type of lien. Any kind of lien, I imagine, would certainly scare away a lender, right, Chris? Like, certainly they'll do like title clear on the property and credit checks
Yeah.
and the like.
Yeah, I mean, fundamentally, maybe what you're referring to are things like, sometimes family has a lien on a property, or even a utility unit, a heating unit, rental that gets registered on title. So yes, we need to have clean title, and postponements can be provided. It's not a deal killer if there are things registered. It's just important for any construction lender or any lender, period. It doesn't matter if it's construction or not, to be in first and or second position. And
So
so
Ronald just clarified materials or trades advance for services and products provided. So I've never heard of that falling under a registered lien in any way, at least not at this scale of construction.
yeah, and Ronald, if they do, the only time you would see a lien from a contractor would be if they haven't been paid, which is why we have that 10% lien holdback. So
Another good question just came up, Chris. How can I figure out my property's as complete value?
yeah, that will be where we're going next. So I'll continue with this quick case study. So this is a case study of John and Mel, and they have they're East Enders, East Yorkers. They've owned their home for 7.5 years. Current market value is about 1 million. This is, by the way, this is a made up, but it is a real scenario of the over the last 12 months. Current market value, $1 million. Current outstanding mortgage, they have a $500,000 mortgage at 2.49% that they arranged when rates were ultra low during COVID. Right. They have garden suite ambitions. So build cost is about $450,000 all in. Build time about 6 months, and we've established an as complete value of 1.4 million. In terms of them as borrowers, strong income, no consumer debts, intended garden suite use is long-term rental. So what are the different options available? They could, because they have equity, they could take out a line of credit as option number one. And the thing to understand with a line of credit is that you're capped at 80% of the as is the current market value. So if the current market value is $1 million, 80% is 800,000, and they have an existing mortgage of 500,000. So that gives them access to $300,000 as a line of credit. In this scenario, they would have to use about $150,000 of their own funds to complete the construction. Okay. So that's option number one. If they don't have the $150,000, it becomes more complex. So perhaps a bank construction loan would be better. And the problem with the cost of doing a bank construction loan is that they would have to pay a penalty to break their existing mortgage, about $5,000. They have transactional costs to arrange a new mortgage, the construction mortgage, and the transactional expenses that we talked about for the draws. One of the downsides is the rigid schedule for advances that the bank would have. And but that would be an option as well. So as they're building that ADU in the back, the bank will advance funds and they'll end up with a $950,000 mortgage at the end. The third option is to do a private second mortgage. So they would leave their $500,000 mortgage in place. We would arrange a new $450,000 second mortgage. It is more expensive, right? So their broker fees and lender fees usually about 2 to 3%. So it's more expensive. Interest rate is certainly higher, right? 10 to 12% because it's higher risk. It's second position. But overall, because they have a good mortgage in first position at 2.5%, the weighted average of this mortgage works out to about 6%. And it's short term, right? It's only for 6 months that they're doing the construction. At the end, they would go back to the bank and they would then arrange a takeout mortgage, consolidated takeout mortgage of $950,000. And they can set it up under their own terms. They don't need to be restricted by the financing that the construction mortgage option from the bank would restrict them with. And so let me just get rid of this here. So here is an illustration again, if you're more visual on this. Current home value $1 million, current mortgage $500,000. Construction costs $450,000. The as complete value $1.4 million. They take out a second mortgage, $450,000. 6 months of working through the construction, the home is complete, and then they go and take out a new first mortgage of $950,000. All makes sense, clear as mud. So now the question that everyone's been asking is this idea of the as complete value, right? This is really one of the main topics of discussion. Anytime we talk about financing, anytime we talk, I'm sure Craig and Daniel at Lanescapes, what does an ADU do to the value of my home? And if you think, you have to think this one through. So how are values typically confirmed in a neighborhood is by doing comparables, right? An appraiser will go out and do a report, look for comparable homes, and do adjustments for different features of the subject property versus other recent sales to determine what that value may be. The problem with ADUs, if you think back to the beginning of this presentation and the fact that there are only 650 ADUs completed since 2018, and of those 650 ADUs, how many people have sold those houses where we get actual market data on them? And the fact of the matter is we don't have that information. We don't have a lot of information because usually people who are doing these projects are holding them for long-term investments and as rental properties, cash flow reasons. So we don't have a lot of data. And one of the rare pieces of data that we have is on a street here on the East End called Chisholm. And this information is a little bit dated. It's from 2025, but we have 27 Chisholm that sold February of 2025. I'm not sure if you can see the property that I tried to highlight there. It doesn't really matter, but you can see there's the ADU in the back. Is that one of your designs, guys? Lanescape?
I'm not sure.
Okay. I've got another picture.
I'll look that up as you continue.
Yeah. And then there was 41 Chisholm that sold without an ADU. So just 5 doors down in June. So 4 months later. So this is a great exercise to compare side by side. So here's what we know. 27 Chisholm. So this is the property that has the laneway, sold for $1.6 million. February of 2025. The main house was a 3-bedroom home, 3-bath. The laneway was an 880 square foot laneway, 2-bedroom, 1-bath. And anecdotally, through forums, this information was all public. Anecdotally, the owner shared that the build cost, according to the owner, was approximately $400,000 in 2018. Now, take that with a grain of salt. But that's what was shared publicly and publicly available information.
So this, I think both of these were our projects, actually. This one was definitely ours, and this was one built by the homeowner. So you have particularly low costs because he built it himself over a fairly long period of time.
Good. So that's additional color to that as well.
And I think current cost would not be far off from this. It would probably be 25 or maybe 35% higher because it is just a garage on the ground floor. So there's not a lot of finish to this one.
Interesting. That's very interesting. I would have thought, this is 7 years later that the cost, with COVID and inflation and all these things, that the cost would be significantly higher. So that's very interesting. So there you go. You get more added color. And I guess the question is, the other property, 41 Chisholm, if it sold 4 months later, and let's say that the house is similar, any guesses as to what that home would have sold for? I'll pose that to the group and pause here for a second. And I think everyone would hope and expect that it would be at least $400,000 less than this property.
We've got a guess in the chat of 1.2 million.
1.2 million, right. It actually sold for 1.325. Okay. And so this, again, there may be more nuance and context to this, other factors, but it is also a three-bedroom home, three bath, and by the way, all this information is publicly available. Go on House Sigma. You can look at the properties and the interior pictures. This one doesn't look as nice from a curb appeal perspective. It's kind of got that unfortunate barn shape.
I
But
was gonna
inside,
say
it's
these prices feel about right to me. This house is substantially uglier and the ADU is substantially smaller.
yes, yes, and so well, yeah, and this ADU actually is just a garage, so there's no actual dwelling on this one. I think this is just a garage building that's back there. So no ADU on this one, and the value, the sold price was 1.3. Now, take from this what you will. I mean, I'm not suggesting, and this is something Craig and I have talked about previously as well. You know, is this a conversation about what is the value? When we're talking to our potential clients, what is the value? Because one thing is the build cost, but it's not necessarily a slam dunk that just because you spend $400,000 to build an ADU, that you're going to see an immediate increase to the value of your home, and have it be the reason that you're doing the ADUs to strictly increase value. There are other factors and benefits, but I think it's important to be cognizant of this as to how the market is treating this, and how ADUs are perceived. And I think in my experience, it's just a matter of not having enough data. Again, there are only 600 ADUs in Toronto. Sales are way down, of course, for other reasons. You know, it's no secret the market is slow, so we don't have a lot to go by. And when an appraiser goes out to do that as complete value of your project, they really have a hard time establishing what an ADU is actually going to do to the value of your home.
So we have a couple questions related to that. One I already mentioned is how do we figure out our as completed value? I think the answer to that is that you have to get a third party appraisal, right, Chris?
Correct. Yes, the third party appraiser. And the job of the appraiser, I guess the point of this case study is to demonstrate the job of the appraiser is to go out and find comparables, which are almost non-existent. Here is a comparable example that widely gets cited by appraisers. And they go, okay, well, cost per square foot, and they kind of base it on this. So that's the answer to that one.
And Curtis has a question about how values relate to cap rates, like in a multifamily scenario. Like, do appraisers ever use the cap rate analysis based on the income?
That's a great question. Generally not. When we're doing residential mortgages, so everything we've discussed today is relating to residential, which means 4 units or less. And cap rates are not used to determine the value of residential real estate for mortgage lending purposes. Now, if you get into fiveplexes and beyond, then we get into commercial, and then values are determined using cap rates.
Right.
Right. One more question as well from Jacob. He's wondering what your experience has been with the CMHC refinance program, and if you've worked on any deals since the start of the programs.
One, and there are two lenders that I have in my roster that I work with. That's BMO and Meridian, that are friendly to it. When it came out, because I was already involved in ADU financing, I was pretty excited about it. And I thought, oh, this is a slam dunk. You know, this is going to open up a lot of financing options because the CMHC, you know, this is a government-backed program, CMHC. The reality is that the uptake from lenders, even though it's offered by CMHC and there's a insurance policy in place for lenders didn't really have much interest in adding it to their product lineup. So it's few and far between. And the borrowers, I think there's a lack of understanding around the program, because most borrowers look and say, well, I don't have a lot of equity in my house to be able to do an ADU or to do a secondary suite. So they don't even contemplate it. So it's really a question of educating. So I'm glad you asked that question.
Yeah, great. Well, thanks, Chris. I think th that was your last slide, right?
This is my last slide. Yes.
So I think at this point, why don't we pivot a little bit to do a bit of a bylaw review? So the way we've been running these webinars, our guest will speak to their expertise, and then we give a bit of a rundown on the zoning bylaws, the design approvals process, and the construction process. And then Chris and we will stick around to the end to continue answering questions. Um,
Sorry, I took way longer than 25 minutes. Sorry, guys.
no, that was great. I'm going to try to be somewhat speedy with mine. Let me just share my screen. Sorry. Okay, so just a quick zoom out. We've been talking a lot about the mechanics of, the structure of the financing for these projects. I always like to zoom out and kind of think about what are they? Like, how do they fit into our housing typologies and to our city? First of all, this should be obvious at this point. They're second homes in your backyard, laneway suites and garden suites. It's important to note that they are not severable. So they always belong on the same property as your main house, which is part of the reason financing can be challenging. You don't just have two separate homes you can sell separately. They're part of the same development. The reason they're not severable is because the services come from the main house. So the utilities are tied together. Not to mention the planning rationale in creating postage stamp lots that don't abut a street would be challenging. It's important to note that the bylaws and approvals to design them is very homeowner friendly. They generally do not require committee of adjustment. The vast majority of our projects go straight to permits, so the bylaws are straightforward and they're easy to follow. Um, they're exempt from development charges. To understand what that is, typically when you build a new unit of housing in Toronto, you have to pay the city anywhere from 80 to like $200,000 in charges for development charges and parkland dedication and education development charges. The vast majority of those are exempt for laneway suites and garden suites. There are fairly substantial HST rebates available. Those were actually recently expanded. If you're thinking about starting a project, but you're a little on the fence, I would encourage doing it now because the HST rebates have been expanded to basically 100% up until next year. So take advantage of that while you can. It's important to note that there's no parking requirement, so often you have to replace a garage with a laneway suite. It's okay to keep parking on the ground floor and put your unit above it if that's what you want. But also, if you don't need parking on your site, you can turn your entire ADU into living space. You don't have to keep parking. It's also worth noting that any development you execute on your laneway or in your backyard does not affect the developability of your main house. So the bylaws view the structure separately. You can still build your main house with the same zoning requirements, whether or not you have an ADU in your backyard. We tend to see clients fit into three buckets. The first two especially would be relevant to Chris's talk. The first bucket we see, which is probably half of our clients, are people building accessory dwelling units with the intention to rent them out to third parties and cash flow them. The second bucket, which I would say is growing and is especially prevalent in the periphery and in the garden suite market, are people looking for multi-generational housing. So that's like putting parents in there, people who are downsizing and want to rent out their main house, or maybe they travel and just need a pied-à-terre. Maybe they have a kid that wants to move out but can't afford a house. And then finally, the third bucket is really personal use space. So home office, entertainment space, guest space. That's a part of our clientele that tends to be small, but actually is one of the few clienteles that sees the best property value appreciation as a result of creating an ADU. Like if anyone's tuning in from Rosedale or the Bridle Path, if you build a really cool accessory dwelling unit in your backyard, the future buyer will value that very appreciably, which is less so the case for other typologies where it tends to be more of a cost recovery endeavor on short timeline. Um, Laneway suites were really the impetus for all of this. That's basically if your property abuts a laneway, you fall into the laneway suite bylaws. If it doesn't, you fall into the garden suite bylaws. Garden suites are slightly smaller. We'll go into it a little. They used to have requirements for sloped roofs that fortunately are gone now, but they tend to be a little more modest because both of these typologies have different context. Laneway houses exist on a public realm where there's already an established pattern of buildings built wall to wall to wall. So that pattern is continued with laneway suites, where you basically just continue to connect the row of garages, but put a second story on it. Garden suites have side yard setbacks and other spatial requirements that respect the spaces around you. Because you don't have a public realm and the roofs of garages to three of your four sides, you actually just have other people's backyards. So looking first at the laneway suite policy, the bylaws are fairly prescriptive in the form that results. There's a requirement to separate your laneway suite from your main house by about 7.5 meters or 25 feet. That's for a two-story structure. If you build a one-story structure, that can be reduced to 5 meters or actually 4 meters in some circumstances. The maximum depth of the footprint is 10 meters, which is a little over 30 feet. And then you have to have a 1 meter setback from your rear lot line abutting the laneway for planting and other streetscape characteristic elements. The maximum permitted height is 6.3 meters. That's basically enough height to have a 9 foot ceiling in your living room and an 8 foot ceiling in your bedroom. There are a handful of other provisions related to laneway suites that tend to be more nuanced. But the most critical element is making sure you can accommodate emergency access. There are two ways that the City of Toronto has prescribed for that. One is via the laneway. So if you're within 90 meters of the end of your laneway, you can use the laneway for fire, police, and ambulance access. If you're beyond that distance from the end of your lane, you have to rely on your side yard. And in that case, the distance between your house and your neighbor's house has to be about 0.9 meters or 3 feet. And your maximum distance from the front door of your suite to the curb in front of your house is 45 meters. Um, Here's an example of a project where we use the laneway for emergency access. The suite was within 90 meters of the end of the lane. And then there's actually a requirement for from that point on the curve, whether you go to the front or down the lane, you have another 45 meters to get to your fire hydrant. The concept here is that a fire truck can't go down a laneway, so it has to pull up to the curb at the end of the lane, and it's got a 45-meter hose to the hydrant and a 90-meter hose to your suite. Now, you've probably noticed we have cited 45 to 90 meters as the distance down the lane. The reason for that is if you're only 45 meters from your point on the curb to the door of your suite, then it's just a normal building in the eyes of the building code. If you're beyond 45, up to a distance of 90, that is permitted provided you include enhanced life safety measures, specifically a fire alarm system with an exterior strobe light that alerts the fire department to the source of the fire. You also have to reduce the number of windows you have and increase the fire resistance rating of your exterior walls. The idea with that is the response time is slightly increased when you have a longer distance down the laneway. So the city wants improved provisions to prevent fire spread and reduce the time it takes to address any fires. This is a circumstance where we used a side yard. And here your distance is limited to 45 meters and 45 meters. Same concept. The truck is going to pull up to the curb. It's got a 45-meter hose to the hydrant. And in this case, only a 45-meter hose to your door. There is no extended travel to get up to 90 meters when you're using a side yard. I'm not really sure why. That's just the way it is. When it comes to the design and approvals process, first of all, you're in the right place. Collecting free information is always step one. You should be reaching out to people like Chris, HST consultants, anyone that you can imagine to get free information. With our company, that starts with a property assessment. We provide these for free. Many of you should have gotten these already, like Daniel mentioned. But basically, you want to verify that your site is eligible. We check for emergency access to make sure that that is going to be solvable on your property. And if it's not, we flag it. There are other provisions you want to check for, like mature trees affecting your developable footprint. Um, is your backyard big enough? Like, what size suite can you build? We try to help you solve that early so that you know if the project's viable. Once you get something like this, taking it to people like Chris is a good next step so you can start to put the piece of the puzzle together. When you're ready to proceed, design and approvals is the primary first step. So that's where you work with an architect like us to create a design and get it approved by the city. We have two approaches to design and approvals in our office. The first, which is the lowest cost and the fastest, is what we call our pre-designs. We have a catalog of building designs that are already pre-engineered and ready to go in for permit, where you basically just pick your facade type and materials and your interior finishes. And our designs that are already prescriptive go in for a permit. Those tend to be the quickest, but they can often leave space on the table because they're predetermined. They don't optimize for the exact size of your lot. So if you do have unique requirements or you want to capitalize on every square inch, going with a custom design is a good approach. Probably, 80% of our clients go with custom designs, usually because, especially if you're building it for yourself, you want to have unique design characteristics. And or if you want to capitalize on the available space, it does make sense to spend the extra time and resources to optimize for your footprint. In our office, we like to use what we call options-based design, where we come up with three different concepts at the outset, like a small, a medium, and a large. We provide construction budgeting with each of those options, and then help you make a wholesome decision as to what approach is best based on how much you want to spend. You can also use those layouts to speak to real estate agents to get revenue forecasts, even talk to appraisers about as completed value. That's a really useful first step to establish a continuum of possibilities and decide where you want to exist on that continuum. And once that's all determined, getting zoning and building approvals is the next step. I mentioned the majority of our projects are as of right, so we can usually fit our projects within the prescriptive box of the zoning bylaws fairly easily. But if you do have a unique lot or you want to pursue unique design, minor variances can be pursued where you can deviate from the zoning bylaw when we can make a justifiable case for it. Going in for permit is really creating a full set of architectural and engineered drawings where we can show the City of Toronto that your structure is adequate, your mechanical systems meet the requirements of the code. We've satisfied all the water management requirements of the building envelope and the life safety requirements of the spaces. And after permits are issued, it's off to the races with construction. Now, Chris, what step in this process do people normally engage with you? I would assume it's while they're working on the designs, right? But prior to starting construction?
Yes. Yeah, it's during the design because again, it comes to this question about as complete value, right? And how dependent it really depends on who we're talking about. But if you're heavily reliant on financing and you don't have a lot of equity in your property, then starting that conversation early to know what the as complete value will be is critical. The earlier, the better.
Oh, good. So, like when we're in preliminary design and we produce our three designs, like our small, medium, and our large, do you think that's an appropriate time for people to speak to you, or is that really kind of like figuring out based on budget and maybe what a real estate agent tells them based on income, they should make their own decision and then go to you later?
No, I think early on again, if there's a dependence, I would take it a step further, and I would say if anyone is on this call or listening that will be reliant on construction financing and the as complete value, much like shopping for a home, before you go to market, you get pre-approved, pre-qualified. So I'm glad you're asking the question, Craig, because I would suggest before engaging in a preliminary design, just knowing that you're qualified for the financing that you're going to need would be a first step. right? I would go beyond that and put it right to the top. Say, okay, are we even able to qualify for $1 million once this project is done? You know, and start there, and then say, okay, green light, we're qualified for 1 million or 1.5 million, and then go into that work of doing preliminary design with you or simultaneously. Yeah.
Yeah, good. For the record, not many of our projects cost $1 million.
Ah,
Just
ah.
for anyone that might have been alarmed by that number.
Yeah, and I think the reason I use $1 million is because inevitably, if you're a homeowner interested in this, you have your existing home with an existing mortgage. So now you have your existing mortgage, and we have to top up, right? So in the end, you may end up with $1 million plus financing because you might have $500,000. So yeah, good point. But all this nuance matters tremendously.
Yeah. Well, and I think that's why it's important to really assemble your project team early. Like architect and builder, I think are critical. Like those are the two elements that we provide here at Lanescape. So having a design and a cost associated with that design are critical. I think a real estate agent is really important. People tend to undervalue just having a discussion with an agent to find out if they did lease it, what would the revenue be, even get like a rough opinion of value before you go through the full appraisal process is valuable. And then also speaking with someone like yourself is probably the fourth piece of the puzzle, right?
Agreed, 100%. Yeah,
Good.
absolutely.
Then you can spend $1 million on your laneway suite. Come talk to us, by the way, if you
Yeah,
want to
hell of a
do that.
laneway, wouldn't it?
When we get into construction, step one is always analyzing services. So, like I said, the services for your site always come to the same place. Like these buildings are tied together through their services. So, your electrical service, your gas service, your water and sewer, those all get delivered to one location on your property. It's up to you to submeter and split them up from there and take them to the two different houses. We have to take our services pretty much always through the main house. Usually, sanitary and water has to go through the basement. Gas and electric can go on the exterior of the home. And then we take it through a trench under the backyard to the ADU. So this is what that looks like, where we'll stub out the sanitary line out the rear of the foundation wall. Everything else is just in conduits that runs through a service trench and is then buried fairly quickly. That impact to your main house, we try to isolate, but you should assume that there are a few weeks of disruption to your basement at the outset of construction, probably between 4 and 6 weeks. After that, everything should be patched and put back to normal so you can continue to live in your house unaffected by the work happening in the backyard. The majority of our projects are slab on grade. It's very rare that we build a basement. However, it is possible to build a basement. Like we probably 5% of our projects have basements under them. The reason that we tend not to is really the cost benefit analysis. Building a basement is expensive. We find it usually adds about $250,000 of cost to a laneway or garden suite project. The reason it's expensive is because we almost always have tight site conditions, so we have to install shoring to retain soil on the laneway and or on your neighbors' properties. And the value you get out of that space tends to be low when you're looking at it for something like a rental utility. So the space you increase or what you increase your rent by building a basement is like a fraction per square foot of your superstructure. I generally tend to say there are only two circumstances where you want to build a basement. One is you have too much money and you're just parking it in Toronto real estate because someday you want your kids to inherit it and that's just a good store of value for you. The other is if it's a personal project. So if I'm building a laneway house for myself and my wife and kids to move into, I'm going to build a basement because I need somewhere to store my Christmas tree and my hockey equipment, and I'm happy to just pay for whatever that cost is. I don't have to justify it through income. Um, I always like to recommend hiring builders and subtrades that have built laneway suites and garden suites before. The access requirements are very different than most house sites. Even things like lumber deliveries, you have to strategize because there is zero space for staging on a site. On our slab on grades we build, we actually don't excavate for frost wall footings. We use helical piles because there's usually no room to stage soil, even for basic excavation on sites like these. Um, so just be prepared to have experienced trades that can be strategic. When it comes to wall assemblies and other assemblies in Ontario, the Ontario Building Code actually has fairly strong requirements for insulation value. Almost all of our projects will receive a layer of exterior insulation that reduces thermal bridging and improves the energy efficiency and comfort of the home. That's basically a code requirement. Um, but when it comes to other elements of the home, they tend to be less prescriptive and more value driven. Like, for example, where you position doors and windows. Uh, this is something where I like to justify the placement of windows based on use case, where if I'm in a multi-generational situation where I'm going to live in the laneway suite or my kids or parents are going to, I'm going to maximize the amount of glazing facing the rear yard because I want my main house and my ADU to coexist in a shared space. However, if I'm putting a third-party renter in my laneway suite or garden suite, I'm really going to minimize the amount of glazing facing my yard and my main house and maximize it on the other side so that they can still have light and views off the laneway, which is a public realm, but not off my personal space. And there are many other elements that go into the creation of laneway and garden suite projects, but they really are a fun typology to work on. The bylaws are very user-friendly, as are the other processes that you have to go through to create them. And they're really enjoyable endeavors in architecture, I think. The expression you get with them is something that you can make very personal. You can match it to your main house. You can contrast your main house. They can be modern or contemporary. They tend to be good blends of multi-purpose spaces. Like we have garages that double as indoor-outdoor living spaces. We have units that, will create a little temporary parking space parallel to the laneway instead of a full garage. There are a lot of ways that you can strategize the use of your space with the needs of your family and your site. And I think this is a good place to wrap it up. We will stick around with Chris to answer questions. So keep firing them into the chat or into the Q&A panel. But if anyone does have to go put the kids to bed, now's a good time to part. So we'll say a preliminary thank you if anyone does log off at this point. But in the meantime, Daniel, why don't we start taking some questions?
Yeah. So Tracy is wondering if row houses are excluded from eligibility just because they're attached on both sides, or whether proximity to the fire hydrant from the laneway can make permit feasible.
Yeah, good question. If you have emergency access down your laneway, so if you're within 90 meters of the end of your laneway, then you're okay. If you're beyond 90 meters from the end of your laneway, you will not be able to provide emergency access if you don't have a side yard. Pretty simple. Get one of our property assessments and we'll confirm it for you.
Great. Damien is wondering how much the property tax will get increased on average after an ADU is completed.
Chris, do you have any insight on this? My understanding is that it's relatively small, the change in taxes.
Yeah. Yeah. I mean, it's so, to answer that question, you have to understand how MPAC works. So MPAC is the municipal, what is it? MPAC, Municipal Property Assessment Corporation. And so they would go out and assess it. And the same challenge exists, when we talked about sort of go back to this as complete value. The data isn't there to support a major change to the value of the property, which is a blessing from a property tax perspective. Yeah. So yeah, I would agree with Craig's comment. I mean, it is going to increase the property taxes, but it's not doubling, that's for sure.
Right. Another question was whether we ever convert an existing garage into a laneway suite, or is it always a garage being demolished and rebuilt?
It's almost always demolition, just because it's very rare for an existing garage to be in the right position on the lot and have adequate footings and structure to support a second story. It's also, there's not a lot left when you preserve a structure, basically just parts of the walls. We're pretty much always cutting new openings or closing in openings. The slab has to be totally torn up for new insulation and services. So 90% of the time, it's better to just start from scratch. It's actually basically the same cost to do that rather than to preserve anything.
Another attendee is wondering whether there's a possibility that the city will eventually approve severance of ADUs if services are not run through the main house, i.e. via row or lane, besides the main house.
Yeah, quick answer to that is no. We have worked on projects that have gotten severances before. A far more popular and easy to access approach is condominiumizing your laneway or garden suite. That is becoming very popular and allows you to sell it separately without going through the headache of creating a separate parcel of land. The circumstances where we have gone through a full severance are only provided when you have a really unique lot, like an unusually large or oddly shaped lot, maybe with double access to streets, like a street at the front and side or a street at the front and back. Unless you have a really, really weird circumstance, it's usually not viable.
Earlier on, there was also a question around the deadline for the HST rebates. So actually, to qualify for that, you need to commence construction prior to April of 2027. What the CRA considers commencing construction is excavation. But we also do have an upcoming webinar, which is going to be tied around the HST rebate. So I would say stay tuned for that for more details. I think that does it for, we do have one more question just around our interest in taking a project on in Bowmanville. So I guess our services outside of the GTA.
We take on projects in Toronto and Vancouver. We've looked at other municipalities, and so far it has not been ideal for Lanescape. What about you, Chris? Do you take on projects all over Ontario?
I'm agnostic. Yeah, from a financing perspective, it's agnostic. Yeah.
Yeah, great. There is one question from earlier I've been waiting to get back to because it is more ethereal. I'm curious about your outlook on ADUs and small multi-unit properties in the downtown Toronto market. With all the headlines about condo oversupply and increasing purpose-built rental inventory, do you still see strong demand from tenants who specifically want to rent an ADU or a unit in a triplex versus a condo? From a landlord perspective, how easy or difficult do you expect it will be over the next few years to find quality tenants and maintain strong rental incomes for these types of properties?
Wow.
Great, great
That's a good
question.
question. That's a really good question. I, I will answer that question just anecdotally. That there's always there's more desirability to be out of a condo, right? To have the standalone, I guess from a lifestyle perspective, to have the standalone benefits of living in ADU, flexibility, lifestyle wise, privacy. And my perception, and I could be biased on this, Craig, you're probably biased on this as well. I would much rather live in an ADU than a condo high rise in a mature neighborhood. These are things that aren't offered because the alternative is a basement apartment or a high rise condo, right?
Yeah. No, that's true. I mean, rents are down across the board. It's just a question of how much your rent is down. I have found that, like with my rental houses, good quality houses in good locations have barely dropped. Like I'm getting very similar rents today than I did 2 years ago or prior to that. It's also dependent on unit type. Like three-bedroom units have proven to be extremely resilient to the current market because they're in such short supply. Like condo towers don't have three-bedroom units. So if you have a three-bedroom laneway suite or multiplex unit, is probably renting very well. If you're in a less desirable neighborhood or you have a less desirable unit, that's where we've seen the biggest drop. So I would say that's where the opinions of people like Chris and real estate agents and really assessing the value of your project before you start it becomes imperative. because building the suite we see in front of us, where it was located in Cedarville, versus building it in Scarborough, would have resulted in very different outcomes.
Hmm.
So basically, call Chris and call Lanescape, and then we'll tell you if it's going to be a problem or
Yeah.
not.
I think it's worth taking into consideration too, like price per square foot, because if you look at your average Toronto condo price per square foot, it's about $800. And I think Craig had already mentioned earlier for our build costs, you're typically looking at anywhere from 350 to 500 per square foot. So there's a big difference on the actual cost of the build.
Sure.
And
Great
then we
question.
Yeah, great question. And then we just got one last question from Diane. She's wondering if it's possible to have an ADU plus the renovation of a garage to add an upper floor for rental purposes in one property.
ADU plus two renovations of garage.
I
So
think
basically just putting a unit on top of a garage.
I think that's what it sounds like. Yeah.
Yeah, I mean, that's definitely
Yeah.
a possibility. And that's something that again, like you will be eroding your income potential because you will get less money for parking space on the ground floor than you would for unit space. But it's circumstantial. Like if you live in your main house and you need a garage, who cares? Like whatever that cost is that you have to bear, that's just your cost to have a sweet new garage and have a tenant pay probably more than their portion of the cost to build the rest. Okay, well, I think that's a great spot to wrap it up. So, Daniel, when is our next one of these and who's it with?
Yeah, so our next session is going to be on June 30th, again, a Tuesday at 7 p.m. You'll all receive the link for that as well, but that's going to be with Randy Moransky. So it's going to be around HST rebates, which were recently announced by the federal government. They're going to be pretty substantial. And then, so yeah, everyone should hear about that. In the meantime, as well, I know a lot of you who sent over requests for a property assessment. Again, I think there's a couple that are lingering, but for the most part, everyone should have received one. So I'd check your inbox if you're curious to see what you're able to develop.
Yeah, thanks everyone. And thanks to you, Chris. Like
Yeah,
your
thank you,
expertise
Chris.
is really unique, and we really appreciate you spending your time with us tonight.
It's an absolute pleasure. Thank you so much for having me. And please, anyone who's listened, reach out with confidence anytime.
Good night, everybody.
All right, good night, everyone. Thank you.